Hello and welcome to Advanced Estate Planning for High Net Worth Families with assets over $5 million. My name is Jim Cunningham, and I will be covering some very important material for you and your family. It's very important to understand that this is a disclaimer. Now, what does that mean? I'm a lawyer. I'm talking. This is absolutely not legal advice. This is information only. Please do not look at this and go out and do a bunch of stuff. You absolutely should consult with a savvy, qualified expert. As we go through the materials, you'll see why. Subscribe to our YouTube channel. If you're watching this live, you can go ahead and put questions in the Q&A and we'll be answering those certainly at the end, but sometimes we answer them as we go through the materials. But do subscribe to our YouTube page to stay abreast of really a rapidly changing environment. I'm a lawyer. I'm Jim Cunningham. I've been a lawyer for 25 years. We have offices in the three major markets in California, and I'm a certified specialist. A certified specialist in estate planning, trust, and probate law. So what happened? We have a new president and a promised tax hike. So we got a spending bill in the spring, and this is just the beginning of spring in 2021 as we record this toward the end of March. And Janet Yellen has said to expect a tax bill in the fall. So we take political leaders at their word, whether we agree with them or disagree. And this is very important. This is not a political discussion. It's not a political debate. I function in the world of reality. We set politics aside, and we do what's best for our clients. So here's the Biden tax plan in a nutshell. And we do have some videos on the Biden tax plan. We do take a deep dive on our YouTube page. But for our purposes here today, Biden's proposing to lower the death tax exemption to $3.5 million. What that means is when a person dies, the first $3.5 million goes tax-free. Anything above that would be taxed at 40%. Perhaps 45%. That's the little bit of a tax increase there. Most importantly, and this is one that really doesn't get talked about that much in the last 10 years or so, the gift tax exemption, Biden is proposing to lower that to $1 million. So what that means is if you want to take advantage, right now you can give $11.7 million tax-free, $11.7 million, and we'll have that number up a little bit later, but you can give that tax-free. If you're married, double it. However, with Biden, he wants to drop the gift tax exemption to $1 million. And this, by the way, is the structure that we used to have, about 20 years ago, where we had this sort of higher death tax exemption and a lower gift tax exemption. So this really isn't new for practitioners who have been around a while. The increase in the federal income taxes from 37 to 39.6%. Most importantly, for capital gains over $1 million, 39.6%. And so one thing that people say, oh, well, if it's a rich person and they sell millions of dollars in stock, they should pay more. So the argument goes. But the problem is many people have worked hard their whole life, and you reach 65, 70 and you say, I'm going to sell my business. Well, guess what? You're going to get hit with that higher tax rate. And that's almost a doubling. By the way, this is just federal. We do have state taxes of 12.3% in California, or 13.3% in California, plus 3.8% federal net investment income tax that pushes you over 50%. Hike in corporate taxes of 21 to 28%. And a hike in self-employment or payroll taxes on income over 200. Now, the reason I say 200 is he's saying 400, but if you're married filing jointly, it's going to be 200. Elimination of step up in basis at death. So that's a biggie, okay? That is a really big one. So elimination of step up in basis at death, whether he gets it or not, we don't know. So what is a high net worth family? I just picked a number, 5 million. But for 2021, we consider a high net worth family or a high net worth individual as somebody with $11.7 million in net worth, or married couple with 23.4. In 2022, which is when we anticipate that the Biden tax plan will become law, a single person, we would consider that person a high net worth person if they have a taxable estate, basically. So anything over $3.5 million. Now, for those of you who live near the coast in California or have any kind of retirement plan, you're probably over $3.5 million if you're watching this. Okay. Or a married couple with 7 million. So we get typically double up when it comes to married couples. Now, regardless of whether Biden gets his tax plan through or not, this is very, very important. Please pay attention. Whether Biden gets his tax increase through or not, the Trump era tax cuts expire January 1 of 2026. That's 5 years from now. So, and that would be a single person would have a $6 million exemption and a married couple would have a $12 million exemption. So the big numbers you're seeing there, 11.7 and 23.4, even if Biden does not get through this aspect of his tax hike, estate taxes are effectively going up in 2026. So if you think you're going to live past this year, you need to pay attention to it. So Prop 19, we're going to kind of do a mashup of Prop 19 on this webinar. a little bit of a mashup, Prop 19 and the gift tax exemption, because you need to look at them together. Something to understand is Prop 19 became effective February 15 of 2021. If you don't know what Prop 19 is, we have plenty of videos on our YouTube page, and you can take a deep dive into Prop 19. Tomorrow we have a webinar. I would encourage you to sign up for it, about all the good stuff in Prop 19 if you're a California homeowner. So you definitely want to check that out. And Prop 19 became effective February 15 of 2021. What is Prop 19? Well, basically, before Prop 19 was passed, parents, by and large, could leave real estate in California to their children, and their children would generally take the parents' low Prop 13 taxes. So they would inherit that very tangible benefit. So many of our clients bought property a long time ago, maybe an inherited property from a parent, and that property might be worth $1 million, but the assessed value might be $50,000 or $100,000. So instead of your taxes being $10,000 a year, the taxes are $1,000 a year, and you pocket that $9,000 savings. So that went away February 15 of 2021. However, the Senate, and it was a state senator from Orange County, who proposed changing the very technical term of what we call change in ownership. But that passed the Senate 34-4. And that proposes to extend the deadline for Prop 19 from February 15 of 2021 to February 15 of 2023. So almost 2 years from today's date. And I expect the California Assembly is going to pass this. Something that's very important. This is what is called urgency legislation, not emergency legislation, but urgency legislation. And this urgency legislation requires a 2/3 vote in each house, does not require the signature of the governor. And this extends, it delays Prop 19 basically until we can have another ballot initiative that perhaps eliminates Prop 19, right? Or eliminates the bad aspects of Prop 19. So it's a really fluid situation. Very few lawyers really understand Prop 13. It's a subspecialty of a subspecialty, but please go to our videos. And if you want to brush up on Prop 13 and Prop 19, please pay attention. So on a high level, we got two things, really three things going on. We have this highly likely increase in taxes that will likely be effective January 1 of 2022, okay? Now, if you have assets greater than 5 million, you really need to pay attention to this, even if you're single or married, doesn't matter. But if you're single and you have assets over 2 million, and maybe you're a little bit younger, you might want to pay attention to this, right? You also may be inheriting from somebody who has assets. And we'll see that there are ways to structure an inheritance so it's not included in your estate when you pass away on an inheritance that you otherwise inherit. So if you have real estate that's protected by Prop 13, if these are long-term legacy properties that you want to keep in the family for years and years and years, extra care must be taken in the planning process, because many of the strategies we're going to talk about, these are frankly taught nationally on a national level. Well, California has this really peculiar thing called Prop 13, and many people want to protect it, right? They don't want their property taxes going up. So you really have to find, the expert in the estate tax structure and gift tax structure, but also the Prop 13 expert. And delaying implementation of Prop 19 into February 15 of 2023, I think it's likely to happen. You may be watching this video on YouTube and it's already happened, right? But I'll call it, I think it's going to happen. Now, by the way, either the Biden tax plan is going to happen or it won't, or Prop 19 will be extended or it won't. But internally in our firm, we're preparing that both of those will pass. Okay. So I would rather be prepared and say, oh shucks, that stuff didn't pass and we kind of wasted that effort, rather than be caught unprepared. So we do have this trifecta, this $2 million wealth level, which frankly isn't that wealthy, right? I think people need to think about this now. Don't wait. You got the Prop 13 taxes. You really do need to assemble your A team now, because in the autumn, when people start talking about, the Biden tax hike, it's in Congress, it's getting proposed. Guess what? Everyone will have already hired all the available lawyers to do the work. So you really need to get on this, get proactive, get ahead of it. And of course, here's the A team. This is not easy stuff, okay? This is not our team. This is from a TV show, just full disclosure. But assemble considering your A team for 2021, but do it now. Don't wait, okay? Whether you call us and you work with us or you work with somebody else, I'm just telling you, you don't want to wait on this stuff, folks. You want to get on it, because there just simply won't be any room at the end. Well, I like to talk about 5 it's 5 strategies for 2021. So this is really the heart of probably why you're here, which is, okay, how does this all work, right? I've heard about this stuff. I might've heard of some of these terms, but I really divide these into 5 separate areas. And the first one, of course, is outright gifts. And what we see is typically the very wealthy, super wealthy people, many times they're just making outright gifts and the kids are spending it or whatever. So let's just say mom is single and she's not married. She has 1 son. Mom has a $50 million estate. Large estate. Mom makes a gift of $11.7 million to the son in 2021. Mom uses her $11.7 million gift tax exemption for 2021. Mom is now left with a $38 million estate. At mom's death, you're going to pay 40% tax on that. So it's going to be $15 million. But this saves $3.28 million because what mom is doing is she is using up her gift tax exemption of $11.7 million this year. So if this is you, something you're going to want to do is you're going to want to consider making that gift this year rather than next year, because if you make it next year, you're going to have to pay a 40% tax or more on any gift beyond $1 million, right? So that would be a $4 million tax liability. So let's look at a slightly smaller estate. Mom is single and she's not married. She has 1 son. Mom has a $10 million estate. Mom gifts $10 million to the son. Mom uses her $10 million gift tax exemption, but now guess what? Mom has nothing. She has 0, okay? At mom's death, there's no tax. There is a savings of $2.6 million, but the problem with this is mom's giving all her stuff away. Look, if you have $50 million, maybe you can give $11.7 million, maybe it's no big deal. But if mom gives away her $10 million or uses the full $11.7 million in giving away all her assets, and she's left with 0, we call that not good in legal parlance. So now, for some people, they may not have a problem with that, but I just want to get you through the concept of outright gifting. So that is an option. Now, gifts in trust, okay? This is a whole other area, and this is where a lot of our planning comes in, as well as a couple of other areas of planning. So there's a laundry list of trusts. What I'm going to do is I'm going to hit the high points on this. Now, this would be a really good idea. If you have a phone, you could take a picture of this and Google these terms, because, the internet and Google is a great resource. It's a great tool. And I encourage you to look at this stuff and educate yourself, because I will tell you, my preference is to have educated clients when they come. That's why we do YouTube videos, right? My preference is to have educated clients rather than somebody where we have to just, go on and on and on about stuff that people frankly can read on their own and be better prepared. So these are the various types of trusts. Let's talk about a grantor trust. Now I put income taxes here. But before we do, there are some common threads. All of these trusts that you see here, are irrevocable trusts. Irrevocable trusts, okay? Now, that means that it's irrevocable. You cannot amend it, and there are restrictions on who the beneficiaries can be, and each trust has its own little rules. Well, let's start with a grantor trust. Now, your living trust is what's called a grantor trust. Now, all that means is when a lawyer says this is a grantor trust, it means the person who set up the trust, who granted the property to the trust, it means that person is deemed the taxpayer, okay? So in this situation, what many of our clients do is they make a transfer of property to an irrevocable trust. It's a completed gift, but the grantor is still taxed as if they own that property, but they don't get any of the money. Now, you may say that sounds like a bad idea, like a really bad idea, but it can actually be a very powerful tool. And so you'll see the acronym IDGT, and that's how you pronounce it, IDGT, IDGT or IDIGT. And this is called an intentionally defective grantor trust. Now, why would you want anything intentionally defective? This is an income tax issue. So, and we have one statement here. I hope you will be able to send me the link to the webinar. I have to leave, but it's over. Okay, great. So Diane, this will be up on our YouTube page probably today or tomorrow. So here's an example. Mom gives away her 11.7 million instead of an outright gift. Okay, it goes into a trust. Now you can think of a trust as a bucket. Okay, this isn't rocket science, folks. It's a bucket. It's a vessel. It holds 11.7 million. It has a handle, right? Somebody's going to be the trustee, whether it's a son or mom or whatever it is. But mom makes this gift of $11.7 million to an intentionally defective, irrevocable grantor trust. It is a completed gift in 2021, and that's very important. You want to make sure that these gifts are not incomplete gifts, right? If you want to use your higher exemptions in 2021, they need to be complete gifts. Now, an expert lawyer is going to know the difference between a complete and an incomplete gift. I won't get into it now, but these do need to be completed gifts, and your Form 709, which is the gift tax return, does need to be filed. So as this $11.7 million portfolio, let's just assume it's a stock and bond portfolio, as it generates income taxes or income of $500,000 per year, mom is taxed on the $500,000, not income taxes of $500,000, but income of $500,000. And so maybe it's $150,000 in income tax. Mom is responsible for paying that. And you may say, well, that's a really bad deal because mom has given away 11.7 million, but now she has to pay the tax on it. Well, it's basically a backdoor way of giving more money to the son. So it saves you a couple $100,000 a year. And that is a grantor trust. Now, many of the trusts that we are going to discuss here are grantor trusts, but these are different variations on a theme. Now, a dynasty trust. What is a dynasty trust? A dynasty trust is also known as a generation skipping trust. All a dynasty trust is it's what we consider a long-term trust and is created to pass wealth from one generation to another generation. So from kids to grandkids without incurring a transfer tax when the child dies. Okay. So what the term generation skipping trust means is the trust qualifies to use up the parent, the person's giving, their generation skipping transfer tax exemption amount. If that just sounds like a foreign language to you, that's okay. We'll have an example here that's a little bit clearer, but the benefit is this avoids the imposition of a death tax on the death of the child. Okay, so this dynasty trust, mom and dad set it up for the kids, and then when the kids died, that's not taxed in the kids' estate. And so here's an example. Mom transfers 11.7 million to a dynasty trust for the benefit of her son, and then mom dies. There's no death tax because mom used up her $11.7 million exemption this year, right? And that saves $4.68 million. When the son dies, the grandkids become the beneficiaries. And let's assume that it doesn't grow. I mean, that 11.7 million could be 30 million when the son dies, and the grandkids still won't pay death tax. So that money can grow, and the grandkids still won't pay death tax. So frankly, this is what wealthy people do. And now we are redefining the term wealthy. It used to be 11.7 million and above. Well, now it's 3.5 million and above. So it's probably going to include the people who are watching this. And there's no death tax. More importantly, no death tax on the death of the son. So a dynasty trust is used to create a vehicle for transferring wealth to multiple generations. So you're not skipping the child. And that's with generation skipping trust is very confusing because you're not skipping the child. The child's a beneficiary. It's just that the tax skips the child, if that helps. So a SLAT is something called a spousal lifetime access trust. Now, this can be very useful in a post-Prop 19 world. So you'll see a lot of these. I see a lot of these in California. There's a lot of rich people in California, right? But I see a lot of these in California primarily for the property tax reason. So spousal lifetime access trust. Dad gives mom $11.7 million. That's kind of cool, isn't it? So dad sets up a trust. And here you go, honey, this is better than a diamond ring. Here's $11.7 million. Mom is the beneficiary for life. Dad is not the beneficiary. And this is really, really important. Dad cannot keep any control. He can't be the trustee. He can't be the beneficiary. This stuff can't come back to him. So mom is the beneficiary for life. Dad is not the beneficiary. When mom dies, that $11.7 million goes death tax free to the kids. Now that can be combined with the dynasty trust, right? You can daisy chain these strategies together. You have to, now some people say, well, wait a minute, if dad can give mom 11.7 million and mom can give dad 11.7 million, problem solved. If they have a $24 million estate, poof, we're good. Well, not so fast. There is something called the Reciprocal Trust Doctrine. What the Reciprocal Trust Doctrine says, and all the doctrine is, it's not a law, it's not a statute. The Reciprocal Trust Doctrine, a doctrine is a line of legal cases that over time builds basically a rule. You can think of a doctrine as a rule that is not created by the legislature, but is created by judges. And the Joint Reciprocal Trust Doctrine says, if dad and mom on the same day, using the same terms, like you use the same trust and you change the names and you're using the same jurisdiction, if they make joint trusts and they each put 11.7 million, that doesn't count. Okay, that just doesn't count. So you have to really pay attention to that. And that's something that you're going to bring up with. Now, there are legal, ethical, moral ways to not have a joint reciprocal trust. And that's something you should talk to your expert advisor about. And this is really the purview of expert lawyers primarily. Accountants, not so much, but lawyers who are trained in this will know about the joint reciprocal trust doctrine and ways to avoid application of that. Now, irrevocable gifting trust. So each person currently, under current law, can give $15,000 to anyone they want. So if there are 10 people in a room, they can give $150,000, $15,000 to each of 10 people, no gift tax, no need to file a Form 709, and that is the federal gift tax return. If you give more than $15,000 to one person in a year, a gift tax return will likely need to be filed. And I say likely, will likely need to be filed if it's your spouse. No, unless the spouse is not a citizen. So there are all these gotchas. Okay, so I'm just giving you kind of the high points, but the bottom line, because it's a very common question, they go, well, how much can I give tax-free? Well, it's $15,000. But if you make that payment to NYU for $95,000 or whatever the tuition is now, that's not a gift because that's directly to the educational institution, and that is not deemed a gift. So it's an exception. So your current lifetime gift exemption is 11.7 million. So you would have to give away 11, if you have not made any prior gifts, you would have to give away $11,715,000 before a gift tax is due. Now you still have to file a return. So if you give $30,000 to one person, you're going to file a gift tax return, but no tax is due. And the government, the federal government, tracks that. So when you die, all those cows come home, all those 709s come home, and there's a tabulation. And we run, get out the calculator in the green shade and roll up our sleeves, and we figure out, okay, well, how much did mom give during her lifetime? And how much is available of a death tax exemption? Because if you give more than 15,000, it erodes your ability to leave 11.7 million or 3.5 million or $1 million, whatever the number is, right? Whatever it ends up being. Biden is proposing a $1 million gift tax exemption. Biden is also proposing a $50,000 cap, cumulative cap. Well, let's look at what the law is right now. So this is the law for 2021. Let's say mom has 3 children and 7 grandchildren. Mom gives $15,000 to each of 3 children. She just writes a check. And, frankly, many families do this. Sometimes they do it at the beginning of the year, and sometimes they do it around the holidays at the end of the year. But many people, many of our wealthier clients do give their kids $15,000 a year. Here you go. Happy Thanksgiving. Mom gives $15,000 to each of 6 grandchildren. So mom can give away, and the purpose of this example is mom can give away $150,000 without having to file a gift tax return. So one person giving, now if mom gave $150,000 to one child or one grandchild, she'd have to file a gift tax return. Whether or not she pays taxes depends on how much her previous gifts were during her lifetime. But what about this? What if the grandkids are under 18? How does that work? Well, mom can use a gifting trust, and many of our clients do this. So mom can give to the grandchildren $15,000 per person per year, but she does that with a trust wrapper. Okay, so you can think of it as this beautiful present of $15,000 a year. You can give the grandchild the check, or you can put it in a trust wrapper. Now, the benefit of a trust wrapper is it's protected from creditors, divorce, predators. There's a structure. By the way, if somebody under the age of 18 gets a gift of $15,000, in most jurisdictions, you'll likely have to open a guardianship of the estate of the minor. Now, there are UTMA accounts and UGMA accounts, UTMA, UGMA. Those are acronyms. The downside, not protected from creditors, and then that money is freely available once the child turns 18 to 25. There's an age range in there. And once they hit that age, they get the money. Well, you may not want a grandchild to get the money at that point. You may want to hold that money back until they're a little bit older and have some more planning flexibility. So the idea here is it reduces mom's taxable estate without using her gift tax exemption. And again, Biden's proposing a $50,000 cap. Now, CUPRTs we used to see a whole lot. We don't see them as much anymore with Prop 19, and I'll kind of explain why. But a CUPRT is a qualified personal residence trust. Now, normally, when you give something away, so if you're a Rockefeller and you're like, we've got this beautiful home in Manhattan and it's worth $1 gazillion. We're going to give this to our kids because we know it's going to be worth even more money when we pass away. But we want to give this to our kids now and just kind of sign over the deed to them and continue living in the property. Well, if you do that, continue living in the property, that asset comes back into your estate under Internal Revenue Code Section 2036A. That's an Internal Revenue Code section that says, look, if you give away something and you keep using it, you really haven't given it away. Nice try, not going to work. Okay. The one exception is with a QPERT. It's a Qualified Personal Residence Trust. Now, what this is this is where you give away your home, your vacation home, typically to your kids or whoever you want, but you retain the right to live in the property for a period of years. When that period is up, you have to pay rent. Now, some people say, I'm not paying rent on my own house, but just work with me on this. You're further reducing the value of your estate. So and you can do it in a way that does not generate an income tax liability. The value of the gift is the value of the residence minus the retained right to occupy. The IRS has calculated numbers on this. So the QPERT example here is mom is 70. She makes a gift of $1 million home into a qualified personal residence trust. Mom retains the right to live in the property for 10 years. That has a specific value in 2021 when the mom makes the gift, and that value is $373,000. So the taxable gift is the difference between the current value of the property minus 373 or 627. Okay, that's how and these are real numbers. Okay, this saves $150,000 in death or gift taxes. So this is, it's a leverage strategy. When let's say mom dies at age 90, she's lived the full term. She's paid rent for 10 years, and the property's worth $4 million. Well, the kids inherit that property $4 million, and they're not paying death tax on it. Okay, so this can be a valuable tool, but mom must survive 10 years, or the whole gift comes back into the estate. So this is a little bit of a wager. Okay, you also will get reassessed when the property passes to the kids. So if you make a transfer of property, and after that 10-year term, because that's after the effective date of Prop 19, the property is likely going to get reassessed, and you'll be paying higher property taxes. But many of our clients at these higher wealth levels are less concerned about that. So irrevocable life insurance trust. And by the way, on property taxes, I'll just say property taxes is death by 1,000 cuts. The death tax is death by 1 cut, because you got to pay 40%. And that is the number, 40% on amounts over $11.7 million. Biden is proposing to drop that to $3.5 million and have a 45% tax rate. So just think about your assets and you subtract 3.5 million and the balance is 45%. That's a big tax bill. Irrevocable life insurance trust. Something to consider is if you are the owner of the policy, your life insurance death benefit is included in your estate. So if you have a life insurance policy of $3 million and you die, that is included in your estate. If the assets go to your spouse and your spouse is a US citizen, no tax. But if that life insurance goes to your kids, it's going to be subject to a death tax. And remember, Biden's talking about a $3.5 million exemption next year. But regardless of whether he gets his laundry list of all these tax hikes, January 1 of 2026, individuals will have a $6 million exemption. Married couples will have a $12 million exemption. And many of our clients have assets beyond that, and they have life insurance. So this is something that we're really going to have to circle back with. 10 years ago, we did a lot of irrevocable life insurance trusts. We kind of have not done those as much lately, but I think we're going to see a resurgence of those. And the Form 712 is what's required. So if you inherit, if you are claiming life insurance, please ask for the Form 712. They don't always give it. And that's basically a gross receipts distribution. Okay, we gave you $1 million life insurance policy. Kristen asks, if my spouse is a citizen of another country, but works and pays tax in California, then what? Kristen, you'd want to check in with us, and we're going to give you instructions on how to make an appointment. But if you do have a non-citizen spouse, there's something called an unlimited marital deduction. My wife is a spouse of the my wife is a citizen of the United States, so I can leave to her an unlimited amount of money. When Steve Jobs passed away, his widow inherited a lot of money, all right, hundreds of millions of dollars at the time. There was no estate tax, no death tax. Okay, so that's something that something you may want to look into is the Qualified Domestic Trust. The acronym is Q, as for Qualified Domestic Trust, QDOT. So Quebec Delta Oscar Tango, QDOT. And Bill asks, for later, my wife and I will be taking residency in Washington State. How does it differ there? Very important. I'm talking federal estate tax, federal death tax. California prohibited a death tax by the initiative process, ballot initiative in the early 80s. So believe it or not, don't fall off your chairs. Ready? Are you ready for this? California does not have a death tax. Don't let the legislature know they might impose one. They might amend the Constitution, okay? Washington State, the last time I checked, I believe has a $2 million exemption, meaning if you die in Washington, a Washington resident, and your assets are 2.5 million, that amount above 2 million is subject to a Washington death tax, even though there's no federal death tax, okay? So it's very, very important. Each state is free to impose its own death tax. As a general rule, the further east and the further north you are in the United States, the higher probability it is that you will have a death tax, and Washington does have a death tax. And Kristen says, should he apply for dual citizenship? You know, I have a bias toward being citizens. You know, if a person's life is here, if their kids are here, I think you should be a citizen. The other thing that you need to understand is if you are not a citizen, if you are a green card holder, you are on a list, and we don't know what the future will bring politically. We are going through really uncharted waters now, but you're better off being a citizen than not being a citizen, because who knows, right? So I encourage people to become a citizen. Is Biden considering making the tax laws gift and otherwise retroactive to January 2021? Yeah, Demetra, you know, the first date that this can be lawfully effective is the date that the bill is introduced on the floor of the House of Representatives. That has not happened yet. If they did make it retroactive to January 1, there would, I'm assuming, be a court challenge, but lawfully, those taxes only can be increased effective the date that the bill is introduced on the floor of the House of Representatives, and that's where this bill would originate. So it's very important to understand that. Now, could they just have it be effective in September 15th? Janet Yellen said expect a tax bill in the fall. Fall starts September 21st. You know, we have about 6 months until September 21st. So now it's time to pick your A team. That being said, is the likely effective date is January 1 of 2022. And the reason is it is very difficult to get a tax hike that's retroactive. So imagine this bill becomes, it's signed into law in December, and they say, oh, you know, these people should have paid more income tax on their W-2. So now you're going to have to ding people. It just really complicates things. So most of my colleagues, most CPAs that I interact with, most financial advisors, we're expecting this to be effective January 1 of 2022. If it passes, okay. I mean, that's a big if. So life insurance trust. Here's an example. Mom creates an irrevocable trust. Son is the trustee. Mom contributes money for insurance premiums every year, maybe the $15,000 premium. And the son pays a life insurance premium. There's some other stuff he has to do. And I'll just, you know, there's other stuff he has to do as trustee with the trust. And then when mom dies, the life insurance is excluded from her estate, and it passes 100% free of any tax. And this is really important. Life insurance is a huge lobby in our country, right? The insurance industry is a huge lobby. The death benefit on life insurance is tax-free. It's income tax-free, but it is subject to the imposition of estate tax. So it's very important to understand the difference between the income tax that it's not subject to, but it is subject to the death tax. And so this is something that I think if we do end up with a lower exemption, a $3.5 million exemption, we'll see a lot more ILETs. We used to see those a lot in the 90s and the 2000s. I think they're coming back. All right, so you may have heard of GRATs and GRITs and private annuities. A GRAT is a grantor retained annuity trust. And I have an example. A GRIT is a grantor retained income trust. So an annuity says, I'm going to give you a certain amount every year, and a grantor retained income trust says, I'm going to give you the income every year. Okay. So private annuity is typically an intra-family transaction. This is not buying an annuity from an insurance company. And we have an example. But I just want to familiarize yourself with this. This is not an in-depth thing. This is just like to know that there are a lot of strategies out there. I really encourage you guys to check this stuff out on your own, do your own little due diligence. But a GRAT is used to minimize taxes on large financial gifts to family members. So what we see is they're typically 2 to 9 years, and mom puts $1 million into a 2-year GRAT, buys the next GameStop, right? So it goes way up. Maybe it doubles. Mom receives her $1 million plus 40%. The current is right. It's like 1.07. So she puts this grantor retained annuity trust. She puts in $1 million, and she's going to get that money back plus interest at about 1%. But any upside, any gain in the portfolio, that goes to son transfer tax-free. Now, income tax is different issue, but the son gets that $960 gift tax-free. Okay, so a GRAT is a great way. By the way, this is on the chopping block with the Biden tax proposal. The Obama administration, at the end of his second term, they really wanted to get rid of GRATs. This is an extremely powerful tool for two reasons. Number one, it's extremely powerful because if you know something's going to go up in value and you want to transfer that wealth to the next generation, this is a great way to do it, free of any transfer tax, free of any gift tax. The other thing that is really great about this is interest rates are very, very low. I mean, how much lower can they go? This number was significantly higher. I remember in practice, it was 6 or 7%. Well, at 1%, it's so low that, you know, this is a great way to transfer wealth to the next generation. Many practitioners will set up what is called rolling GRATs, a 2-year GRAT now, and then 6 months later, or a year later, another one, and they kind of feed into each other. So that's a strategy. And Demetra asks, when you say there is no death tax in California, does that only apply to California residents? What about out-of-state residents who own California property? Important question. If you're a resident of Washington, Washington will tax all your property wherever it is. That's included on your Washington gift tax return. If you're if you live in California and you own a property in Washington, well, if you own a property in Oregon, I know this is what Oregon does. Oregon above $1 million has a death tax, and it's up to 16%. So if I'm living in California and I have a $10 million estate, and I own $1 million home in Oregon, they're going to fully tax that $1 million home. I'm probably going to pay 16%, $160,000, or my estate will, but they add that on top of your other assets. So you have this $1 million exemption, but if your assets are more than $1 million, they kind of add that Oregon property on the top, and it's fully taxable. So you're not able to use that $1 million exemption. And we have another question is, if we gift our real estate to our children, is it based on the gross value or the value net encumbered? It's going to be based on, for gift tax purposes, the net value of the property, but we're going to talk about that with a limited partnership. A GRAT is used, okay, we talked about this. A grantor retained income trust. I don't really see these a whole lot. You got to watch out for the joint reciprocal trust. This is used to minimize taxes on large financial gifts to extended family members. So you can't use this for your kids. You can use it for nieces and nephews. So if you say, hey, sister, you know, my sister, I'll give 11.7 million to your kids and you give 11.7 million to my kids, you got to watch out for the joint reciprocal trust doctrine. So that is an issue. But a grantor retained income trust, and we don't see these a whole lot. They're kind of restrictive. And a private annuity kind of is similar to a GRAT in conceptually, and that's where typically the parent transfers property to the child, and the child agrees to make payments to the annuitant according to agreed upon schedule in exchange for the property transferred. So this is, again, used when the underlying asset will appreciate. And the nice thing is this is not a transfer that incurs a gift because it's an arm's length transaction. So mom transfers assets that she knows will increase in value to a private annuity, and son is obligated to pay mom. In exchange for transferring the property, mom receives a fixed payment over time. So mom puts in $1 million and says, give me back $1 million a year plus interest over a 10-year period. That's a private annuity. The increase in assets transferred goes to the son. So that is the power of the private annuity. So any increase, and this is what we call an estate freezing technique. So, you know, the best one is, you know, eliminate the tax. The next one is to freeze the increase in value. So at least that value moves to the next generation and is not captured in the parent's generation. I thought the estate exemption after sunset was 5 million per person. Has this been changed to 6 million? That's anonymous. It is 5 million, but there's an inflation index. So when that passed in the early 2010s, it said it's 5 million bucks plus an inflation adjustment. And so when I say 6 million, you can think of the 11.7 million minus 5 is 6.7. No, it's 6.7. So it may be higher than that. Right. But we're kind of guessing maybe 6-ish. And Azam asks, if you have some 401ks or IRAs in your estate, is the deferred tax interest in them used to reduce the value of your estate? No, oh boy, if you have a taxable estate and a 401k or an IRA, it's the worst asset. And we're going to talk about some ways to mitigate that toward the end. So gifts and entity wrappers. What are entities? Entities are companies, okay? And this is where we're talking limited partnership. You've heard of a family limited partnership or an LLC. You can gift all or part, and you get something what is called discounted valuation for lack of marketability and lack of control. And this is really a very powerful tool And so here's an example. Mom has $18 million in real estate. It's all she has, a bunch of real estate. Maybe she has an apartment building of 18 million. She gifts that to the family limited partnership. Mom then transfers limited partnership shares to the son. The son cannot sell these shares and has no control. Mom stays 100% in control. The value of the gift is reduced. Maximum reduction, 35%. I was talking to a client yesterday, he says, I heard you could get 50%. It's not going to happen, right? Some of my clients, they go, 35, I'm a little nervous about that. Let's do 25 or 20 or 15 or whatever it is. But 35 seems to be the more or less, for a planning device. So basically what you do is you reduce that $18 million gift by 35%. And that compresses the value of the property to 11.7 million. And by doing that, you're able to transfer $18 million of property for 11.7 million. No gift tax in 2021. Now, if you're looking at this and you're saying, well, that sounds really easy. I'm hitting the high points and there's a lot of stuff that has to happen in here. But my point in doing this webinar is just to familiarize you with the concept, because one of the things I don't want to have happen to people this year, really what happened when Prop 19 passed, we were so busy going through so many matters. And I kind of felt like the clients really didn't have enough time to really let it soak in, because these are really big decisions. So I really encourage you to start this thinking and this research now, so that you're living with these terms and you're living with these concepts for time, because this is a really big deal. Okay. I get that. And this is a really important decision, but you really need to, I think you need to understand what's going on. So again, that's a limited partnership. Charitable gifts. We do have a whole webinar, Taxes Begun, Charitable Tax Strategies in Estate Planning. That is on our YouTube page. I would really encourage you to, when this is done, go to our YouTube page, subscribe to our YouTube page. That's really important. So hit the subscribe button, and then it'll pop up in your feed on your television, literally, right? When you go to watch something on YouTube, and you can stay in the loop on this and stay educated. So there are a lot of charitable strategies. I don't want to sort of reinvent the wheel. I would really encourage you to go to our other webinar, Roth Ira Conversions. This is a really important, and this was the question that came up about, hey, how are these taxed? Something you need to understand: if you have an IRA or a 401k and it is not a Roth, the income tax has not been paid on that. So if you have $1 million IRA that's included in your estate, taxed at 40%, and then when that money comes out, guess what? The beneficiary is going to have to pay tax on it. So you're effectively taxed twice. So they're not the best tax efficient strategies. So there's a lot of things that we can do. And so one of the things, high level, there's no RMD, required minimum distribution, at 72. For those of you who have a Roth, congratulations. That Roth money, you don't have a minimum distribution. And you may think, well, I don't really care because I wouldn't pay tax on it, but you still don't have a minimum distribution. And we meet with many clients and they have IRAs of $1 million, $2, $3, $4, $5, $10 million. And those minimum distributions, they run about 5%. So when you start looking at this, you're like, wow, 5% of 5 million is $250,000. I'm paying an extra $125,000 a year in tax. I don't like that. And so there are things that you can do. Okay. This can be coupled with some advanced life insurance strategies, which is effectively like a Roth strip out, where you intentionally take the money out, you pay the income tax, you do the tax bracket arbitrage tax bracket management. There are a whole other universe of income tax planning strategies. So if any of you make over $1 million a year and you're like, I'm paying too much in tax, there is a lot that you can do to mitigate your tax bill. Okay. So if you're not doing that, I would encourage you to take a look at that, and you can do that with our firm, frankly, or many other, income tax planning law firms. We all use similar strategies. But again, there's a supply constraint is the people I'm talking to as lawyers, we're already busy and it's not going to get slower. Okay. So you need to get your A team together. And this minimizes income taxes in retirement and for the children. So we do have this webinar that we did in January. I would really encourage you to take a look at this. We kind of take a deep dive into the strip out strategy of an IRA. And we combine that with life insurance. And that is a very powerful tool, because remember, life insurance passes tax-free. So you either do a Roth conversion or you put it in life insurance. And there's reasons why you would do one or the other one or both. I'm just heightening awareness for you guys. I would really recommend you take a look at that webinar. It's a very good webinar. Philip has a question. I have $15 million in a 401k and die, do I have to first pay income tax followed by paying estate tax? That would take 75% in taxes. Well, Philip, here's the rule on that. And we have yet another webinar where we covered the Secure Act. So if you have 15 million in a 401k, here's what happens. The 15 million is included in your estate. So $11.7 million exemption for 2017. So that delta would be taxed at 40%. So it's whatever, $2 million, whatever it is. With the Biden exemption at 3.5 million, now you've got 11 point, whatever the math runs out on that, 11.5 million in subject to a death tax. So that's a $5 million tax bill. You're gonna have to pay that 5 million. If the only thing you have is the $15 million 401k, right? You're gonna have to take out 5 million from the 401k to pay the tax. And now you've incurred another tax liability. So to answer your question, it really depends on the context of what's going on, but that 401k is taxed. It is included in your estate. It's a transfer tax, which is lawful under United States. A wealth tax is different, by the way. I don't think a wealth tax is constitutional. I'm just going to say it. I see a lot of constitutional experts agree with me because there's no transfer of wealth. They would really have to amend the Constitution. So when that 401k transfers to the beneficiary, the government's free to tax it, right? Because it's a transfer of property. And then you got to pay that death tax. Now, the source of the funds to pay the death tax, if it's the IRA itself or the 401k itself, you're going to be subject to penalties or a income tax. However, there's a new set of rules. It used to be that when you passed away, your beneficiary would have to start taking money out the year after you passed away. Well, now there's no minimum distribution in most cases. I mean, there are limited exceptions. And again, we have a webinar on the CARES Act where we cover this. But that 401k does not have a minimum distribution until the year that contains the 10th anniversary of the death of the owner of the 401k. And that date is December 31. So if I have a 401k and I die this year in 2021, my children, the date that contains the 10th anniversary of my death is 2032. They don't have to take out the money until December 31 of 2032. So sometimes it's good to wait, sometimes it's not good. It's really a function of math and tax bracket arbitrage. And this is why you really need, like I said, an A team. You really do need the financial advisor, accountant, insurance professional, attorney. You might even need an M&A attorney if you're selling a business. You got buy-sell agreements on a family business. So there's this whole A team that comes together. And I really encourage you to assemble that team now because folks, I'm telling you, I'm calling it. If you are reaching out to people in October or November, I don't think you're going to get a lawyer. So it's going to be really, we're seeing a real crunch on the supply. Our Roth IRA balances are higher than the estate tax exemption. We're 60-ish and healthy. Can we reduce our estate without giving up 20 plus years of tax-free growth in the Roths? Yes. You would frankly probably couple that with life insurance. Okay. Life insurance and Roths, you can think of them as tax-free buckets. So one of the things that you might consider is for if you have a very large Roth, one planning strategy would be to take a withdrawal from that Roth and put it into a life insurance policy. Okay. So you're making a gift because you're not really able to make a gift of a Roth that passes at death. How you make a gift of the Roth is you pull the money out and you give it. But it's many times it's better to do that in the vehicle of an irrevocable trust that buys a life insurance policy. And look, I'm not here to sell life insurance. I'm just telling you that's how it's done. And life insurance has a massive lobby. And some people say, I don't believe in life insurance. That's fine. But life insurance is used for a lot of different things. And in this case, it can be coupled with some pretty powerful strategies. And the clock is ticking, folks, because today we have an $11.7 million gift tax exemption. I think it's going down to $1 million. Okay. I'm shocked in the last year what's happened. The government has printed so much money and stuffed it into the pockets of so many people. It's really starting to twist our economy in good and bad ways. Okay. But this is a different world. All right. And one of the things I've covered in prior webinars is modern monetary theory. Modern monetary theory. If you don't understand what I just said, Google it, modern monetary theory. Here's the idea. As long as there is enough productivity available in the economy, the government can print as much money and push it into the economy and not cause inflation, okay? But once inflation starts burbling up, the federal government uses taxation not as fiscal policy, not as a method of raising revenue, but as monetary policy, as a way of pulling money out of the economy. So when you pay your taxes to the US Treasury, that money is actually destroyed. They don't have a bank account. A lot of people don't know this. That money just gets pulled out of the economy. So it's very important. If you don't know what modern monetary theory is, educate yourself on it. There's a lot of stuff out there on the internet. Subscribe to our YouTube page, super important. We're going through massive change in our society. We're going through massive change in taxes. And you don't want to be left without an advisor. So here's what you can do. You can go to CunninghamLegal.com to set up an appointment, or call our 800 number. If you're outside the United States, you can call our 530-269-1515. The advanced planning consult's $1,000. Now, here's what I'm seeing in the estate planning market. Very few lawyers are doing free consultations anymore. It's just not happening. It's because we're getting busy, okay? And what you're gonna have is vertical demand. What is vertical demand? That's where the demand far outstrips the supply, and you can't even find it really at any price. But here's what we're willing to do for you guys. We're gonna do a consult. There's a questionnaire that you fill out. You give us your personal balance sheet. You give us maybe all the prior estate planning you've done. Send that to us. We take a look at that. We then block out time and have a very productive meeting with you. And at the conclusion of the meeting, there are two choices. Number one, do nothing, right? And sometimes that's what happens. Or the second one is do something. And that's something we can certainly talk about at the meeting. Please mention that you're seeking an advanced planning consult. Okay, we have different consults for different things, but this is advanced planning consult. And obviously, if you do work, additional fees apply. But again, and I really say this, whether you choose to hire our firm or whether you choose to make an appointment or not, you need to pick somebody, okay? You need to find that expert lawyer, and you need to engage them now, because we cut people off with Prop 19. There were hundreds of people on a waiting list that we were unable to serve, hundreds, okay? It's gonna be the same with this crunch time. And this did happen in the last decade, about 10 years ago. Remember the fiscal cliff? A lot of people ran to their estate attorney to do planning. But I think we're entering a new era of American history. We're really tinkering with what the dollar means. We're tinkering with what money is. We're tinkering with a lot of things. We're trying to cure a lot of social ills. I mean, just take a look, right? But this is a very important time in the United States history, and it's a changing time. I think we're going to have higher taxes, and that's going to be a permanent feature, because taxation will become monetary policy, not just fiscal policy. So don't wait to set up your A-team. While we'll open it up for questions, I got to put my glasses on so I can see the questions. Go ahead and put your questions in the Q&A. And we've got Anonymous, so I answered that. Denise asks, did you say annual $15,000 gift will be capped at $1 million? How will the IRS know that you gave $15,000 gift in order to determine if you hit the $1 million? They'll know because you tell them, okay? So it's like the income tax. You volunteer that information to the government. And clients will say, well, if I just give my kids, if I take out $25,000 in cash and give it to my kids, how will the IRS ever know? I don't know, they probably won't, okay? But I'm not going to tell you as an attorney, don't worry about it. I have to tell you, I'm an officer of the court. If you give somebody more than $15,000, you got to fill out a Form 709, right? And Azam says, thank you for putting this on. Anita says, do 709 forms filed with the IRS expire? Does a gift given, say 10 years ago, still count against the estate tax exemption? Yeah, Anita, it does. So those cows come home. So if you made a gift in 1970, it's coming back. If you made a gift in 1990, it's coming back. All right. And Terry says, thank you so much. I thought you didn't have to report. Denise says, I thought you didn't have to report $15,000 per year. Yes, Denise, if you give someone $15,000 per year, no reporting requirement. If you give them $16,000 a year, you got to fill out the form. So I thank you for clarifying that. John says, if your assets already exist in a revocable trust, will they continue to be protected as the tax laws change? No, John, a revocable living trust is what we call an alter ego. So it's an alter you. Ego is, I, and it's another version of you. And in the United States, if you have a revocable living trust, that means it can be amended, it can be changed, it can be modified, that is treated as you. And so that's a whole topic for another conversation, but I would really suggest that you reach out to an expert, again, whether it's us or another firm, have them take a look at your living trust, because, and frankly, I think a lot of living trusts are going to be changing when that exemption drops down to 3.5 million. Now, Jay asks, son now lives in the house that was rented in an LLC. The LLC has been dissolved. So now how can we transfer to son? Oh, that's an important one. That is a potential Prop 13 issues. Jay, I would just recommend you call in and we can help you out. Is the $15,000 gift tax exclusion to be capped at $50,000 with Biden? You know, that's kind of, that's what he wants, I guess. I mean, that's part of the platform. But again, this is a laundry list of things, you know, and you know, do I want to show up and eat cake all day and have a pony and a balloon in my office? Sure. Is it going to happen? No, I don't think so. Right. How much of this goes through? We don't know. I think the big stuff, the $3.5 million exemption, I can see that going through. So there's no cap on giving $15,000 a year, and the $1 million number is not related to the 15. Yes, Denise, that was our example where we said, you know, Denise, you could give $15,000 to each of 3 of your children and 7 of your grandchildren, as long as you give $15,000 per person. That's $150,000 under current law. And this is March of 2021. Under current law, you can give $150,000 to all those people, no gift tax liability. And Lola says, thank you for another informative webinar. And when does a living trust have to be updated? Is a trust established in 2007 get overridden by new tax laws? You know, Anonymous, your living trust, the last iteration, the last version is your living trust. If it's been since 2007, I would have it reviewed. You need to take a look at that. There have been a lot of changes in the way that people approach estate planning. I would say the three biggest areas where we see the most change is who the trustee is, right? Many times people will name a sibling or a friend, and the kids now they're older. So you're changing who your successor trustee is. That's, you know, if you get hit by a beer truck, you know, who's going to handle your affairs, or a cement truck, who's going to handle your affairs? Well, it's going to be that named successor trustee. That's the person who steps into your shoes when you're not serving as trustee. The other one is there's a heightened awareness for asset protection for the beneficiaries. And so typically when people pass away, most trusts that we see, they say, if our kids have reached the age of 25, everything goes to them outright. But what if one kid's in the middle of a divorce or the middle of a bankruptcy or a lawsuit, or, you know, has some other thing going on? They may not want that money. They may want it protected. And so what we're seeing is many people are adding protection into their estate plan for the inheritance, because I will tell you, inheritances are much bigger than they were 25 years ago when I started practicing law, much, much bigger. And the third one is a trust protector. So many living trusts do not have what is called a trust protector. Now, a trust protector is a person who has power over the trust, but is not the trustee. This is very, very important for two reasons. Number one, you may run out of trustees. Certainly on a dynasty trust, if this thing's going to go on for multiple generations, a lot of those people you name, they're going to be dead, okay? Or, you know, or something else. And the other one is to changes in the tax laws. So a trust protector can modify provisions to make the trust more tax efficient. And I will tell you, every time we see a trust and something needs to be changed and they don't have a trust protector, pretty much every time we're going to court, which is a pain in the butt. You don't want to go to court, all right? Aisha asks, can a beneficiary of a lifetime asset protection trust resign as trustee when they have creditors, or is that against the law? Aisha, I would recommend use of a trust protector. So typically what happens is in these trusts, these protective trusts where you do have creditor protection for the beneficiary, the trust protector can remove a trustee and remove the trustee who's also the beneficiary and replace that trustee maybe with a private professional fiduciary or an institutional fiduciary, or some other competent individual, somebody who's not an employee of yours or related by blood or marriage, and that enhances the creditor protection. So, is that a fraudulent resignation? You know, I don't know. Is it fraudulent? I don't know. It would hinge on the facts. Can you explain the Clayton election? When does it need to be made? Clayton election is a reverse Q-tip election. Basically, it's a very technical thing, but in a living trust, when one spouse dies, you have a free look. You can look at the estate plan. And frankly, for most of you if you're watching this, you need to Google Clayton election and look at it, because it's probably what your expert lawyer, probably likely what they're going to recommend. He or she'll recommend it if you're married. A Clayton election allows you vast flexibility on the death of one spouse, whether to fund a trust, whether not to fund a trust. Something to be mindful of, the Clayton election, one of the primary benefits is preserving the generation skipping transfer tax exemption amount, because under current law, a spouse inherits the deceased spouse's exemption amount, meaning whether it's 3.5 million or 11.7 or 6 million, one spouse dies. If you file a portability return, that's a form 706, portability return, terrible name, portability return, you actually inherit your spouse's death tax exemption. So now you can double up on your death tax exemption. You do not inherit the generation skipping transfer tax exemption. That's highly relevant when you're talking about dynasty trusts. So Clayton Election, I probably should do a webinar on that. Aisha asks, yes, a disinterested trustee, Aisha. Anonymous asks, can a trust be the listed beneficiary? Do you have to list a person or on investments or life insurance? A trust absolutely can be the beneficiary. Some complex tax stuff in there, but absolutely can. Is it useful to have an advanced planning consultation with you, even if we are moving out of California this year? Yes. Right? It is, because frankly, a lot of these gifting trusts, we're not even putting them in California. They're cited in Nevada, right? Why Nevada? They don't have state income tax. So there are a lot of, but absolutely, if you're moving out of California, it's worth the consult. And if for some reason we don't end up helping you, we can certainly find a colleague in another state. I'm part of a network of about 5,000 lawyers. We can find a colleague who's trained in another state and get your A team together. And I said, I know I'm repeating myself, but get your A team together. Do not wait. Mark says, if we make tax saving strategies in 2020, if we make tax saving strategies in 2021, are they grandfathered in future tax laws? I would say the general answer is yes, if the trust is irrevocable. Okay, so typically the date the trust becomes irrevocable, the law applies that date. Now, is it possible that Congress could change some law down the road that changes something? Yes. That's why you would want to consider having a trust protector in your trust so that you could make changes to make the trust more tax efficient. So Aisha asks, Bernie Sanders has only gone as low as a $3.5 million exemption for the estate exemption. I think it's doubtful that it will go below that, but we also are in massive debt, so I suppose anything is possible. Aisha, I did see something in the news about $1 million death tax exemption. I think that would be, frankly, catastrophic for many families. Okay, so many people have assets greater than $1 million. And Michael, thank you. So last question, Roth conversions. When I take out my IRA RMD at 72 this year, can I use as an example $100,000 and transfer it into a Roth IRA? How do we estimate income taxes? Are we double taxed by this transaction? Anonymous, that is not a Roth conversion. Your minimum distributions are your minimum distributions, and the Roth conversion is in excess of your minimum distribution. That being said, there are planning strategies. One thing you can do is you can make, if you do make a charitable deduction, you could certainly transfer 100,000. There's a limit. You can transfer 100,000 to your religious, wherever you worship or charitable institution. You can do a transfer directly to that institution, and that takes care of your RMD. So it's something to take a look at. I would highly recommend, Anonymous, that you check in with a qualified financial advisor on that, on effectively some type of strip out strategy. But when I say by strip out strategy, it means taking more than your minimum distribution, or even before your minimum distribution. You intentionally take that out of your IRA in order to avoid these much higher minimum distributions down the road. So it kind of evens out the taxes. The other thing to consider, this year our tax brackets are lower than they will be in the future. The historical norm, you hear about people returning to the historical norm. The historical norm is significantly higher than what it is, okay? I mean, it's a lot higher, 30, 40, 50, 60, 80% higher. Are we gonna return to those? Maybe. I don't know, not clairvoyant. But a strip out strategy is a good strategy. So Kevin asks, if I leave 60% of my estate to charities in my living trust, is that 60% not counted towards the portion of my estate subject to death taxes? Generally, yes. So that would be a charitable deduction. Okay, well, I think that's enough. Thank you for attending today, and go ahead and if you'd like to do a consult, reach out to us and think about getting your A team together. All right, have a great day.